Hello everybody, it's Yashar here, back again with another video. And in this video, I'm going to revisit Algonquin Power and Utilities stock and update my valuation to see if it's finally a good time to buy this Canadian utility stock. I posted a video almost 2 years ago about AQN stock, and at the time of publishing that video, AQN stock price was over 18 Canadian dollar per share. I analyzed the stock and concluded that the stock was overvalued by around 47%, and the fair value of the stock was about 9 Canadian dollar. I also mentioned in another video that the management team at AQN will probably cut the dividend as the cash flow of the company was not able to support paying a dividend, and they had a huge pile of debt with insufficient cash flow. A lot of viewers at the time were disagreed and believed that the stock is cheap, but as we covered in the past, the stock price dropped by more than 50% in the coming month, and the company was forced to slash the dividend twice. They also forced to terminate their purchase agreement with Kentucky Power, and they were forced to sell $1 billion worth of assets to delever the balance sheet, as they had significant debt. They also just appointed a new interim CEO, Chris Huskilson, who was a former board member, to hopefully recover from all those bad capital allocation decisions in the past. I should add, a lot of activist investor hedge funds like Starboard are also impacting the board decisions recently, as they have major stake in the company at the moment. They also increased their number of shares in the last couple of years, which is again extremely negative for the share price. Basically, none of these factors that I mentioned here were positive, and as a result, the stock price declined dramatically in the last 2 years. Okay, so I mentioned all the bad news and bad decisions that management team at AQN made in the past, but now after 2 years, let's look at AQN stock again and see if the stock offers any value today. A quick summary about the stock: AQN trades on TSX for almost $7.20. The market cap of the company is $5.5 billion, and they pay a dividend with starting yield of 4.9%. It is a power and utility company, operates mostly in United States and Canada. The company operates in 2 segments, regulated services and renewable energy group, with a primarily focus on regulated electric, water distribution, wastewater collection, and natural gas utility systems. Okay, to start building the model, I imported a series of general parameters from AQN earnings report, like the current share price, their revenue, their number of shares, their net debt, which is their short-term and long-term liabilities minus their cash or cash equivalents, and their net income per share. I also put my expected rate of return to be 10% for this stock. For me personally, I would increase my rate of return to 12.5%, but let's go with 10% for now to find the fair value. Now, in this model, I will calculate the fair value of the stock by projecting their future earnings and then discount the terminal value and future cash flows minus the liabilities of the company back into the present value of the stock, based on 3 different scenarios. In the bear case, or the most negative case for the stock, the business will have a little bit of margin compression. They will dilute you as a shareholder by almost 3% per year. I consider them to have almost 1% share-based compensation to reward executives and employees, and be able to grow their revenue by only 2% in the short term, 5% in the midterm, and eventually by 7% in the long term. And I considered a terminal multiple of 10, which is in agreement with historical bear periods of this stock. For base case or normal case, I considered a little bit better margins, revenue growth, and also lower amount of share dilution, and a terminal multiple of 16, which is historically an average multiple for this stock. Finally, in the bull case or best possible outcome, I considered a little bit of profit margin expansion, 0% share dilution, a 6% short-term, 9% midterm, and 12% long-term growth, and a terminal multiple of 22, which is a bull multiple for this company. Now, if I hit calculate, the software will give some valuable information about the stock based on my assumptions. First of all, it gives me a tip. The net debt of the business is high compared to its future cash flows, so you may want to adjust the model to take this into account. It basically tells you that this business has significant debt on its balance sheet compared to its future earnings, and therefore you probably want to increase your margin of safety in your calculations, and I usually do this by increasing my expected rate of return, but for now I just ignore this message. Okay, Next, it gives you intrinsic value of the stock in each scenario, and then it will provide you with a fair value estimate, which is $6.89 per share for AQN. Comparing to the current share price of AQN, it is still trades at 4% premium today. It is not a buy according to the model. The most important problem of AQN stock is their debts, and I think managing this level of debt would be extremely difficult for management team at AQN with their current strategy. I would personally increase my rate of return to 12.5% as this stock has a lot of debt on the balance sheet. Let's see how the results changes with 12.5% return. Now the fair value is $5.5, which means the stock is extremely overvalued based on these expectations. In summary, if you're fine with a 10% return year over year and you want to accept the risk associated with the depth of the company, the stock is probably fairly valued today. But if you want higher returns with lower risks like me, the stock is not a buy according to the model. There you are, guys. I hope you enjoyed the video. I will come back with a new stock analysis video soon, but until that time, I see you guys in the next video. Farewell.